It's Gil. It is 8:15 a.m. my time out here on the west coast of California, where you never have to go on vacation. You just stay where you are. I got Dr. K here with me, and we wanted to have a live webinar today just to go over the situation in the market. For those of you who caught me on Fox Business News this morning with my good friend Stuart Varney and company, you probably heard me say that I would A, sell the rally, and B, cut out of precious metals in the short term. And of course, we put that out yesterday in a Market Lab report, an MLR report, stating that we think there is a short-term top in the precious metals. And this is based on a very simple concept, and I know you probably heard me talk about this many times before, that concept of forced selling. I noticed, interestingly, that was something that Bill O'Neill used to talk about back in the late 90s when I worked for him. It's interesting that you see that now more in the media and on financial TV, this idea of forced selling. But it's a very simple concept. Dr. K, that's for you.
Yeah, I'm gonna let it go. The business
anyways,
call. It'll go to voicemail.
So okay, where was I? Okay, this concept of forced selling is basically this. You know, the market comes down hard. Institutional investors, hedge funds, a lot of whom are leveraged, and I know a lot of you out there understand this already. But for those of you who don't, they start getting margin calls, or they have charters that they have to maintain some level of liquidity or baseline against any margin positions, or all sorts of components that cause institutional investors just to have to dump stocks. And generally, they'll dump the most fungible at any one time. So you see everything get hit, and that's what you've seen. It's very ugly with the market. And so the other component here is that if this is the case, then most asset classes will likely pull in. And we still consider the situation here very volatile, very news-oriented, and very difficult necessarily to play, because we've come down hard off the peak for the last, 10 days now. And I never really felt like getting aggressively short. I was playing a few shorts here and there and picking off some points. Sohu's been a decent one so far. But in hindsight, there were probably more stocks that could have been traded on a short-term basis on the short side. But it wasn't really there for me. I felt that we were too far down, and the risk of a snapback based on some news development was too high. And I still think that's mostly the case. So I think if you're trying to short here, do it in measured fashion. Don't get carried away. If there is a major bear market developing, there will be plenty of opportunities to short, because all of the leading stocks are just starting to break off their peaks. Okay, once you have that move, it takes sometimes several weeks where you really get into, say, the right side of a head and shoulders or some other formation, even maybe a pod, a punch bowl of death. And that's where you're going to come in and start to short. So, but the bottom line is, yeah, you could have come in and made some money off the peak. There were some stocks that could have been hit, but to me it was dicey. The potential for a snapback rally is very great here. And I think this morning you might have been panicked if you were short for a brief period of time. But you heard me on Fox say, just sell this rally, because forced selling looks like it's going to carry this a little further. I think the S&P goes to 1140. The NASDAQ is undercut the 2600 level. So I'm just showing you here my screen. This is one of the screens I look at. You know, everybody's always asking, how is your screen set up and what does it look like? Well, you know, I got my buy list here, which is turning into a short list. I got a short list here. I got stocks I'm watching here, here, and here. So there's no real methodology to what I do. And I can tell you Dr. K likes to break his screen up into, he uses boxes like these, and I believe he uses one for each group out there in the market. So he's able to see at a glance with colors what's going on. I think a lot of websites like FinViz allow you to see a lot of that already. So for me, I try to look at as little as possible. And so this is enough for me on one screen. But I have several other screens, and you know, depending on what I'm in the mood for. Some of them even, you know, I reverse the color scheme just to kind of take that edge off of the way the colors can influence you. And some I have color schemes that are much more, say, benign, with more pastel blues instead of greens and reds and stuff. You notice I do put some blue on here. Notice how that calms you down? See? Isn't that calming you down right now? Anyways, Let's look at the NASDAQ. So I'm just going to look at my charts here. This is my daily chart of the NASDAQ. Let's make it nice and fat here. You undercut the 2600 level. This would seem to me to set up a logical rally, but that didn't occur. You had it this morning, and you ran into resistance well below the 2600 level, and you're going down. We put out a sell signal here 4 days ago, and which always comes with the usual 2 or 3 snide emails, which we always enjoy. But the next day, you get this reversal. And I would have thought maybe another day of rally up into the 200-day and then roll over, but I was surprised yesterday. They just gapped that thing down, and they took it down. And what happens when you gap down yesterday, if you're looking to get short on a rally, now you're kind of in a frozen position because the market's down, and you're not sure whether it's going to gap down and then turn around and rally again. So it's very difficult to come in on the short side. So it's very tricky here. In hindsight, you could have said you could have shorted some things here and they come straight down, but that's a pretty brutal drop. And in my view, the steepness of that drop looks like 2008, where you had forced selling, and it looks like that's exactly what you have going on right now, just based on the steepness of this drop. So right now, if we kind of blow this up to kind of see where we're headed, it looks to me like you might be headed in here. You may be close to a support area on the NASDAQ, somewhere between, looks like 2465 or 67, something like that. In here, just this general zone, and you might be finding some support here. There's not a lot, so you may have some more problems, but you're coming on top of this whole pattern here right now. So things are looking pretty grim, and we're in cash for the most part. And we'll get to silver and gold, but as we said yesterday, we thought you should just unload them on the short-term basis and wait to buy lower. So I don't have any volume here, but what's the volume rate right now, Dr. K? Is it pretty heavy?
On the NASDAQ, well, here, let me check the website that actually has a relatively good indication of that, because Wanda is a little bit, it overestimates at this time of day. Right now, we're at, on the NASDAQ, 45%. And on the New York Stock Exchange, 45% as well, above the average. That's huge. That is very, very huge volume.
So you've got issues here. You've got
and that's relative to yesterday, or that's relative to the average. So, I mean, this could be potentially a, one of those capitulation days.
That's something to keep an eye on, and given where the NASDAQ is, you're close to some support right there around the 2,500 level. But I'm looking for the S&P to come down into 1140. Of course, it may undercut something in here or bounce off of this support today and then try and rally. So, for the most part, if you're trying to get short, you're in no man's land. If you want to get long, you're an idiot, I think, because you're trying to catch a falling knife, and I don't see anything that looks all that great. There's been deterioration in this market for a considerable period of time. When the market rallied up off the 200-day, this rally here was not too bad, but this was right into the end of July, or June rather, and that's when QE2 was ending. So I think you had a QE2 encore rally there, and then you kind of come down and test the 50-day, you bounce off it. But what I noticed is on this bounce, about the third week of last month, July, breadth was actually declining, so you weren't really getting a big thrust in excuse me, in breadth. So you were seeing things fall by the wayside, and that was pretty obvious because we were talking about this earnings roulette thing, where earnings are slamming some stocks, and of course some stocks rally, but sometimes they're just rallying back from breakdowns, kind of like Priceline today. But that's where we are with the indexes. You could be at a fear bottom here. It makes sense at any point in here that you could turn and rally. So playing the short side becomes dicey, but that's okay because you're still early in the ball game, in my view. So as far as shorting goes. So meanwhile, let's take a look at the metals. Silver, I thought was a short this morning, and I just think it's a short because it's probably coming in. So if you're a tactical player and you want to play for a couple of points on the downside, here's a pretty easy reference. You got 38.40. I think it's pretty clean resistance this morning. So you rally up in here, you can short it in there. It's coming down right now. I'm making a little bit of money with this, but I'm just kind of day trading it and kind of getting a feel for it. I'm just running about 10,000 shares of this. I'll be right now on the short side, so nothing really huge, at least for me, but it is working so far. So in any case, that's what we're looking at here on the. Let's look at the daily chart on the intraday. So I see 38.40 as intraday resistance. That's also roughly where the 20-day is. Let's blow this up a little bit. So here you close below the 20-day on the SLV. If you go below this low, then you have violated it. But you know, so far you can't tell enough about these to know whether they're going to follow any particular moving average right now. It's kind of in the air as far as saying, oh, it's gonna, you got to use a 20-day or use a 50-day. I think right now I would use the 50-day as an ultimate stop for those of you who want to brave it out, and I admire you for that. But after this, I think you're underneath the 20-day probably. You're underneath this area, and you could come down a little lower, and then you throw in the potential for forced selling. So, I mean, we could be wrong, and these things may still be viable. I think longer term they are. But I think you could get a little more pullback, and there is risk being long anything when you have forced selling. Dr. K, any comments on that?
Yeah, well, we all know what happened in 2008, and as I wrote in the report yesterday, the you know, everything got taken down between 50 to 90% from the peak when the market collapsed in late 2008. Gold was the best performer out of all the instruments, but even gold got taken down about 25% from peak to trough. So, you know, when you got forced selling, there is no safe haven except the short side.
Or cash, but now they're charging you to hold cash if you hold too much.
They're charging you.
Right? Yeah, that's what. There's a couple of banks I think that are charging large investors a lot of or fees rather for holding cash. They don't want them to hold cash. Put it in stocks. That's what they want them to do. So that's what we're looking at there. Let's look at gold. Gold is acting a lot better, obviously. It's holding up a lot cleaner, so you know, that's actually okay. It could be held, I think, but we just kind of want to lay back and see where this all goes. You can see the market now. You're only down 27. You were down 100 and something just a moment ago on the Dow, and now you're trying to rally back. That's a pretty sharp move. Let's take a look at this. Yeah, you can see this on the 5-minute here. He's suddenly jacked up right into the 20 period. You can see how the 20 period moving average on a 5-minute tends to show resistance most of the time. Sometimes you get faked out, but I do use that on a 5-minute just to check intraday trends. So I don't know what caused that. Was there some news? Anybody out there?
I'm not seeing
I like
anything.
some of the snide remarks about
Reaction rally.
Looks like it. So, but like we said, you're in a position where you could bounce at any point. So that doesn't surprise us. A little funky though. Let's look at it on a 1-minute here. Yeah, just in the last couple 3 minutes. So
There could be a lot of volatility in the days ahead as well, which is means more risk, which means staying in cash in an environment like this is probably your safest or most prudent option.
So that's what I like about real-time webinars. You get to see what's going on. But anyways, you see a lot of selling come in here. So I think that's telling you, though, that there is a move towards raising liquidity. So I wouldn't be surprised if it just tracks sideways. And since we do have some profits on the positions, we didn't see any reason to take any, stick our neck out, rather. And I think that makes sense if you're up for the year. So you want to play defense. I think even if you're down for the year, you don't want to let things get out of control. So it doesn't hurt to just back away and relax a little bit here. So some of the stuff, somebody's asking if Priceline is a short. Well, it's going to have to fail. Yesterday it failed through the 50 days, so this would almost be a, you get a cup of the handle and it fails here through the 50-day, which is the blue one. I got my 65-day exponential is black here, and the 50-day simple is the blue one here, okay? So you got the breakdown here in volume. Now that's a late stage base failure. Now you have this rally back above on earnings, but you're not breaking out. It almost looks like you do have clear resistance at 540. So if you were coming in here, you could try and short this. I did earlier, and it pushed against me very quickly, so I just blew out of it very quickly, just testing it. And it's still volatile. So I saw it hit down to 515, 516 just a little while ago down on this move. But it could flop around in here. But one thing I would watch for is a break of the 50-day moving average. So I'm willing to test it a little bit and see if it's weak. To me, it just seems like a dead fish or a fish you just caught and it's flopping around on the deck right now. So it's not really clear whether it's going to break down just yet. But this would be a late-stage failure. Then you watch the rally, and if it breaks down, I think that's potentially shortable. If you can sit through a 5% move to 540 and use that as your stop on the upside, then you could probably put out a little position here and test it. But that's kind of the setup you'd be looking for on a late-stage failed base. And there haven't been a lot of setups just yet, I think, on the short side. At least not enough that they're in playable position. Because I know I talked about these last week. And the one thing that bothered me here is that, well, you know, this is a, you can see the head, you got the left shoulder here, and these are a few right shoulders. The fact that you're right down in here along this support area made me think that you probably were going to see some kind of a rally. And I was thinking you might have it over the last 2 or 3 days, but that just didn't happen. The market really likes to fool the maximum number of people these days, and I think it does what most people don't expect. Most, I think, expected a nice rally on a good jobs number, which theoretically you had, even though it is a phony number. Everybody knows that. But on TV, they have to act serious about it. Fortunately, they didn't really ask me about that today on Fox. But I was looking for a bounce here. But look at how this just breaks down, and it's just getting hammered. But there's still risk trying to come in and short it here. You had to kind of catch it here. It was very tough to actually short this one because you had the gap down on earnings, took it down below the 50-day a fair bit. You could have tried to short it using that as your stop, but that gets a little tricky. So not the best setup. You really had to be anticipating it on these rallies. And of course, let's go back and think about that SKYY ETF that was going to buy all these cloud stocks, and they all did this. So I'm wondering if you could have anticipated it on that basis. But you just try to take the information in real time and go with the best risk-reward proposition. So right now for us, mostly the best risk-reward proposition is to be in cash. So let's see. Buy, sell, or hold on Priceline. Well, I talked about Priceline. TGI, I don't know. It's not a stock that we really talked about. So, you know, are we doing buy, sell, or hold? I don't know. Where do you own it? What's your stop? If you're asking us whether we think it's going lower or higher from here, yeah, roll the dice. Crocs. I'm wearing my Crocs. I have about 8 pairs. I did buy them in October of 2007, however, and that was the top in Crocs. I bought iPads a few months ago, and I thought that would be the top in Apple, but that didn't occur. But Crocs has been doing pretty well, and they're still selling well. I understand that their new shoes are doing, their new styles or models or whatever you want to call them, they are doing pretty well, and they've been doing well. It broke out down here, but I've never really trusted it. Simply because there's been all this red volume when it came out, but it still worked anyway. So, but I don't know, buy, sell, or hold. Depends where do you own it. If you bought it up here, you probably should be out of it. If you bought it on the breakout here, well, what can you sit through? So we don't get into buy, sell, or hold. That works for TV. Sometimes we do it on the radio. But if the question really is it going up or down from here, we don't know. Do you know, Dr. K? What would you say on Crocs? Buy, sell, or hold?
My crystal ball is no better than yours or anybody else's. But you know, you got to base it on your risk management. I mean, if you know, you're in the hole on this thing, then you got to get out. If you bought it early and you're sitting on profit, then you could use my 10-day, 50-day sell rule. In other words, it broke the 10-day. If it breaks the 10-day within 7 weeks, then you can switch to the 50-day moving average. Yeah. But also keep in context with this kind of market environment, which is pretty treacherous, and you know, you might want to wait and just be in cash until, you know, wait for the dust to settle, because if the market has a lot of volatility over the ensuing days, and that means going up and down, straight up, straight down, and who knows how far down is, you know, it's going to take everything with it.
Yeah. So all that means to say we don't know. So some questions. This is an interesting question. I think we're trying to make this a quick one today, but we'll see how long we go. We're flexible. You have had portfolios for a long time. Well, ever since I started investing in 1992. If you own things that are up 100%, do you sell off your entire portfolio when corrections happen, or do you have trailing stops that track the top? Dr. K?
Well, I'd personally prefer to sell when stocks violate my sell rules. So rather than selling into strength, I like to sell into weakness. and I like to buy into strength. Now, there are exceptions to that rule, such as the period we're in right now, where early yesterday, I looked at precious metals holdings and I realized, these things look a bit toppy. They're entitled to pulling back. And second of all, if the market really comes apart, we could have a mini version of 2008 where gold might not drop 25%, but it might drop 5 to 10%, and that means silver's going to drop 20%. So I don't want to be sitting in these positions way up here, and so that was my decision to move to cash early in yesterday's trading day. So you always have to be aware of what the market is telling you, the information you're being given. But normally, I prefer using trailing stops.
Yeah, myself, if I get a sense, if you've been in a bull market for a long time, and I think in this case you've had about a 3-year run, so you're getting long in the tooth here. If things start to really weaken, you can play it on a stock-by-stock basis. But a lot of times, if I've got other stocks that either have been going for a while or look like they might be in later stage positions, I'll just go to cash. And I feel much more comfortable just blowing out very quickly and then looking to re-enter. It's just psychologically much easier for me since I play so aggressively. I will make a lot of money when I'm right, but I also lose a lot of money when I'm wrong, so I often want to just blow out if the environment in general doesn't seem favorable. So Dr. K and I might handle that a little bit differently. But that also here's a lesson that I learned in 2007. Let's go back on this daily chart of First Solar, and I thought First Solar is a great example of a stock that, and I own this. I had it at that time, and I'll even show you how silly this all was. We had bought it. This pattern here reminded me of AOL in 1998, and so when it broke out, I was buying it in here because I was getting see this voodoo day here. You got very light volume right there, so it was drawing up in the handle. When that happens, a lot of times I'll just step in and buy a little position, and we were doing that. We actually were doing very well. And I know Bill Griffith, our trader, is on the webinar, and he remembers this because it's almost comical. We ran up, and so we started doing pretty well, and then one of my other associates in the fund that we were running at the time starts giving me this spiel about how the market's topping and 50 reasons why the market was topping at that point. The indexes were weak. So on this day, it started to break the 20-day, and I sold all of my First Solar. I sold JASO. I had a bunch of other solars, SPWR, and I dumped them right here and didn't buy them back. And of course, the market did top right around this period, and but this stock continued higher. And the lesson here is that markets can top, but leading stocks can often continue a lot higher. In the past, I would often hold my stocks if they're acting well, and I should have done so in this case. Knowing what I know now, I would have just bought this back on the same day. But the lesson here is if you think you're just going to blow everything out because the market is weak, sometimes that can be a mistake. You may have something on your hands that is much more powerful. Now, conversely, if you look at SunPower, that was in a later stage pattern. We'll go back to 2007 here. But in October, see here, the market topped and it went in like parabolic. So these should have been held. And I held on to these, and the positions I had, and Billy, you remember this, because I told him as we were buying these breaking out, I said to him, we're going to have a hairy sell-off day here pretty soon in the next few days, but we have to sit through it because you have a group move in solar stocks, which is also a major new concept in the market. So you've got that working with it. The other thing is when you see a group of stocks and the concept is pretty new and they're all moving together, that's telling you there's something significant going on. And I knew all these things, and I pretty much told Billy this, my trader, and what we had to do, but I did get scared out when I had another associate telling me, oh, the market's topped and you better get out, lock it in, because we were up like 15%, right off the bat, 15, 20%, which for some people is a lot of money, but for me at the time, that's not what I was looking for. I'm looking for 100%, 50%, 100%. And I could have gotten it if I had just stuck to my own guns. But, the lesson there is don't assume that just because the market's topping, leading stocks are necessarily going to top. So using trailing stocks is often the right thing to do. The other part of that lesson is don't listen to people who don't know what the heck they're talking about when it comes to making big money in the market. and that was another one of my mistakes. But it's all my fault, and live and learn. But that's just the case that I think you should keep in mind right now. So what do you own that's acting well here? Lulu, I don't think so. Apple, you had this move the other day. That was, you could have called it a pocket pivot. Didn't clear the 10-day, but my thing was, if it did, and this was a pocket, you would have seen it confirmed by going through the 10-day period the next day, and that didn't happen yet. Big volume breaking down. I tend to think Apple is potentially a late stage formation. Therefore, it's very risky here. And of course, if you can't hold this breakout level, and I'm going to say 365 down to 355, that's pretty much a zone of support at the top of the space, then you may have a late stage failure. And these are some of the things I've talked about on TV, but the bottom line is it broke out on earnings and it's held up. So right now, the only thing you know for sure is it's heading back to its pivot point. But with the late stage potential in this space, it could be trouble. So I'd keep an eye on this, because if Apple comes apart and breaks the 50-day and turns into a late stage failed base, then you're probably looking at more downside for the general market. So the one short sale setup we've talked about and we've acted on has been Sohu. Now, I think Sohu is a good example of why, if you're going to short, sometimes you've got to give things a little bit of room. And we brought this one up in here, right smack in the middle between the 200-day and the 50-day simple moving averages right here. You notice how sometimes you might use a 65-day exponential. I've noticed what that accounts for is the slipping and sliding past the 250 days, which are commonly used. So I think they become too obvious, and that's really the big problem. So what you're looking for here is, here you have a formation that looks like a head and shoulders. The only problem here is that when you look at this, I guess it has had a decent move off the lows, but coming out of a base and all, it doesn't look all that impressive. But you could say this is a shoulder here. Here's your big head. You got several big volume spikes on the downside coming down. Let's make that a little bigger. And here you are. You fail here on heavy volume. Now, to me, that is usually, this is like a pod to me. It's only half formed and never really made it back up to the peak, but it's still kind of like a late stage cup in any case. Very deep, 110 down to 65, not quite, what is it, about 40% or something. Dr. K, you want to calc that for me real quick?
Well, it's about 40, yeah, 41.
Yeah, see, that's why I keep Dr. K around.
Your human calculator.
What's that? Yeah, the human calculator. Let's see. All right, so what we got going on now is, so you have this break, and you get 1 day of a bounce off the 200-day moving average. There's your shot to hit it right in here. So I was actually messing around with this. For those of you who are on the webinar last, I don't know, Tuesday I think it was, or whenever it was, you know that I was actually hitting it in here. And now we're breaking the 50-day here. Volume is declining yesterday. Where's it at right now? Let's take a look real quick. You're running 88% above average. So you've undercut this level. Now, you look like this is one level it could undercut and rally. I mean, that's a potentiality. It's not, doesn't mean it has to. A lot of the weakest stocks, and when the market's really weak, these things will just blow to pieces. So it could be heading to 65 as the first area that undercuts. But there's a couple of things to think about, and I talked about this real quickly yesterday when we put out a short note on Sohu and what you're looking at in terms of your price targets. This would be your first price target, so you'd be watching for an undercut here in a rally, but the rally may only take you back up into the 50-day moving average. But that would take you from where you're at now at 71.88 up to 76.27, and it could slide past depending on what the market itself does. So I think you got to watch out for that. Excuse me for 1 second. Just going to adjust something on one of my PCs. Anyways, so that could happen, but then I'd be looking to short it on that rally. The other thing that could happen is that you could break to this low, but there's also this area of congestion which could provide like a cushion of support, and so you might see it. This would be a logical place for it to bounce from. So, shorting it here, you come down about 12 points or so, maybe a little more. You're getting 15%. If you got in here, you're getting 10% maybe. So not a bad idea to take a little off the table and see what happens here, because if it bounces, you could definitely come after it. Also, the market's way down, so the potential to make big money on the short side declines as the market comes down sharply. But that's not always the case. So you could hedge by taking off half and then seeing what happens. So usually, what I like to do is just hit and run. Just hit them. If I get a nice profit, then just run away. That's a very common technique. So I would keep an eye on this one here. But we're looking at fresh situations potentially in price line, depending on what happens today. If it closes below the 50-day, then you would probably have a late-stage failure. You got earnings out of the way, so you don't have to worry about earnings roulette on that one anymore. But if you're shorting this yesterday, you're getting stuffed in here pretty good. So. And probably a move like that would have stuffed me out had I been shorting on this break. But you can come back after it, testing it in here. And I may come back after this again. So I got pushed out of it real quickly one time. But I think Priceline is one stock you got to be careful with, because when it gets going, it can get going very quickly. Let's see, what else? I don't think you really want to be long anything right now. I noticed Fusion.io came out with earnings, and not a bad report, but this thing is not ready because the market is not ready. So don't expect anything, any miracles here from Fusion.io just yet, but I do think it's something to watch over the longer term whenever we come out of this. Somebody made a nice profit on Sohu. Thanks. You're welcome. LVS has looked ready to break down for a long time now. I think it actually has broken down. And what you've got here likely is, let's review this whole thing. Oops, swirl. You can see here, climax top. So first you have a climax top. You break down here, and now it's failing. Remember, this was shortable here, but then you rally a couple times, and now this could be the final break. And you could have probably, I guess, tried to short it as it's breaking down through the 200 or 50-day moving average, but I was expecting some kind of a bounce off of these, and just not happening. Just not happening. And I think that tells you how weak this market is. So I do think if you follow the market direction model, because you got to remember also with the market direction model, usually one true signal will make enough money to make up for all the little nicks and cuts and scratches that you got on a lot of false signals. So, and also I think Dr. K has been very explicit about the fact that in this environment, you don't want to necessarily be too aggressive one way or another. We felt very confident with the precious metals. And of course, with our comments yesterday, we are explaining that we don't feel so confident at this juncture, given the forced selling in the market. So, we're we're wary there. But the sell signal on the market direction model stands, and if you hit that one on Tuesday, you should be sitting pretty right now. And if you aren't, I'm not sure whose fault that is. Actually, Dr. K, if you're losing money, whose fault is it?
Well, you really can only blame yourself, and sometimes it's not even a matter of blame, because if you traded right and you sold right, and your account is down, you should still be very happy that you obeyed your rules. That's really the key here, because you're not always going to make money. We all have drawdowns. The best that have been around for 30 years, more than 30 years, and obviously there's O'Neill, there's Livermore, who traded his whole lifetime. You're going to have massive drawdowns sometimes. But if you traded right, first of all, they shouldn't be massive, and then you should be very happy about that. In a year like 2002, I wasn't up very much. I was up less than 1%, but I was very happy about that, just because 2002 was brutal. On a relative basis, I was very happy that I was able to, stay out of the market for the most part.
But that's because you're a genius, Dr. K. All right. I was going to okay, let's answer some questions. You got a couple of questions. As long as silver keeps going lower, I'm fine. I don't have anything to worry about, so I don't have to go anywhere just yet. Here's a good question. Will you be giving guidance on how to build on ETF short positions put on with the MDM signal, or will it just be recommendations on stop shorts? So I guess, look at the market break now. I guess they're asking, Dr. K, are you going to follow up with add points on the MDM, or is that really something that is possible to do?
No, that's totally discretionary. I mean, that's in a way it's outside of the scope of what we're providing. However, that said, there will be junctures where I might write a report where I see a point in time where this is perhaps a place where you should take some of your profits off the table, or maybe here's a pyramid point. But the whole thing with pyramid points and the market direction model is it really is up to each individual member to determine for themselves what they want their exposure to be and how they wish to reach that level of exposure. So if someone, say, has a view of they want to be 50% long a particular ETF, they can either just follow along with the model and just go all 50% every time the model switches signals, or they can piecemeal into it. And on a year like this year, which is very prone to whipsaws and false signals, as I've written in the reports, people might want to pyramid in, piecemeal into their full positions, just so that if the model is wrong, then they won't lose as much money. And the model, of course, has its fail-safe, so you're protected on two levels. You're protected on the pyramid, where you'll lose less on a false signal, and you're also protected by the model itself, which generally keeps losses to less than 2% on a 1 times ETF. So if you're doing a 3 times ETF, then and some of these ETFs are pretty wild, like TNA. That you could be down 10% on the position. So if you went 50% in and you're down 10%, then your account is down 5%, and you have to ask yourself, is that something that is permissible based on your risk tolerance? And that said, I mean, the market's just cratering here the last few days, and the TNA, I think, is up something like 20% or something on the model just in a few days. So TNA is a wild one, so handle with care.
Yeah, I would say on a practical level, if you could probably try and do this on your own by looking at resistance and support levels on the indexes. So if you're using the SQQQ, for example, or the QLD, what is it, or the QID, then what you might look at, if you had a rally back up into this level at 2600, maybe you could try and pyramid your position there. If that went further, you might stop yourself out and look to put out somewhere closer to the 200-day moving average. So in other words, use rallies to add to your ETF positions as long as the market direction model stays on a sell. If you get the type of rally in here after 2 or 3 days that produces a buy signal on the model, then I think that would tell you to probably just blow all your inverse ETFs out. But that might be one way I would do it myself, just thinking about this, how I would handle, say, a position in the SQQQ here. I would definitely be keying it to the NASDAQ. So if I took the position on the sell signal this day, now what I'd be looking at, so figure I probably got a cost basis that's in here, okay, on an inverse ETF. So it's based on the NASDAQ being in here. So this is my break-even point. And what you'd be looking at now, the first add point would be on a rally up into resistance at 2600. And if that doesn't hold, you can either cut some of the position or just blow the whole thing out, looking for it to break that again to come back after it, okay? In other words, to buy it back. So what you could do is rally here. Okay, so position 1 taken here, breakdown, rally up into 2600. Theoretically, a potential add point. So add, say, position size 2 to make your whole position now. Let's say it continues to rally past, and you've set a very tight stop. You could cover it again. If it continues up into the here, you can think about adding again, or you can wait for it to roll over again and break support here at 2600 to add the position. So you might give up a little bit in here, 1% or so, maybe 1 or 2 or 3, I don't know, but somewhere in there you might give up if you're going to play it tight. But that's one way to think about doing it. I mean, there's a lot of ways to skin a cat. I don't know if Dr. K would necessarily endorse this. Generally, the model, the way the results are shown on the website, the performance is based on just going 100% in whatever ETF on the signal. Right, Dr. K? You don't have any performance based on pyramiding. So
right. It's all in or all out, and that's that on a 1 times ETF, the model's long-term returns are around 33% a year, 1 times. So on a 3 times, if those 3 times had existed, they're relatively new vehicles that have come to be. You'd be theoretically up close to 100%. And to give you an example, also, I was saying about TNA being such a wild one. This year has been the year of the whipsaw. And the model has had, if you look at something like TNA, it was up, down, up, down, up, down, and down a number of times on false signals. 3 of those being very small losses for TNA, simply because the model was just kind of testing the waters. But the last loss on the model was 12.8%, which again, that's in keeping with the type of trading that TNA does. I mean, it's one of the most volatile vehicles out there. But since the model tends to, on balance, be right, and most years are not this challenging, if you believe in the model and the model's long-term track record speaks for itself, then your best bet is to use the TNA. The TNA gives you the best risk-reward. And actually, I was saying that the TNA was up 20% as of a couple days ago. Actually, as of right now, as we speak, the current sell signal is up just over 30%, based on where it went short on TNA. So, be prepared for a lot of volatility, but when the model is right, it can be very right.
And that's really the whole point. So, some people ask us, why are we up when some of you maybe are losing money? And I think a lot of that depends on, I just wanted to point out right now, silver trading at SLV trading at 37.14. The violation of yesterday would be 37.11. So you blipped below it, so you undercut it, but you're holding right now just above it. But I'm going to guess that you're going to violate and you're hitting lower. So, and of course, I am short the SLV right now. But anyways, what was I talking about, Dr.?
You were going into about the signals on the. You were going to make a point after I made mine about the 3.
Well,
I was going. Actually, this is an exciting market. I mean, this is really. I don't know if exciting is the right word, but this is really, really unbelievable. I mean, it feels like September of 2008 when the whole markets just started to crater, and the TLT, which is the price of the long bond, started to shoot higher, and that's exactly what it's been doing the last few days.
And that's a little disconcerting. I'm not sure if that's showing a lot of fear or the fact that there's something coming down the pike. And yesterday's breakdown in the market was not due to the jobs number. It was due to the market seeing something else, because the current news is nothing more than the current news. The market's looking out at the future. So I tend to look at the current news as being an alibi for whatever's going on. Someone asked an interesting question. When did you get comfortable running such big positions? When I had a lot of money. When you have deep pockets, you don't worry about sloshing it around a little bit. So
that's why, like we said in the last webinar, only trade what you can afford to lose, because then you can go there with a lot of mental stamina, and you can take those big risks when they're worth taking.
Yeah. And that's really what happened. I mean, unless you really want to be crazy. When shorting stocks, you mentioned downside. Okay, we talked about that with the MDM. Given the amount of cash some of the larger players are sitting on, how do you know they're sitting on cash? I hear that all over the place, but it doesn't seem to be keeping the market from going down, so I don't think it's really a factor until it's a factor. And meaning you're not going to anticipate a low in the market based on the fact that a lot of large players have a lot of cash. Well, great, they have a lot of cash. They might need it for something. So that's how I would look at it, John. Yes, I'm giving you a bad time, John. That's just because I know you so well. Let's see.
Which John? Never mind.
John Ward.
Tell me afterwards.
How do you build your buy watch list in a period like this? Stocks that have higher relative strength. That's basically it. So for your initial position size, do you scale in like IBD it teaches, or do you buy all at once? Well, I like to go in, 30 to 50% positions right off the bat. Those are my starters. Dr. K, I think it's more like 10 to 25, right, Dr. K?
Yeah. Again, it depends on how much long exposure I have overall, and also market conditions themselves. I mean, when the window opens, the window of opportunity on the long side, I will sometimes be fully margined within 3 days, just because there's enough stocks that are issuing buy points, and I don't argue. I just go full on. But other times the market's been very unruly this year, and so I can easily say that I haven't been on maximum margin on the long side. If I've done anything being maximally on, it's because I've seen some shorting opportunities and some long opportunities. So in a way, you could say it's hedged.
There's a lot of questions about, they're kind of nebulous questions about QE3 and whatever. I think I would say an answer to all those questions, what will Bernanke do? What about QE3? What about all the players with the lots of money on the sidelines? And what about all the players with lots of money who are in the bathroom right now and will come out soon? Um, and all that. I say just watch the market. And what you're seeing is extremely weak action. So we think our call, moving to cash with the precious metals, just take your profits. And the sell signal on the MDM, so far they're working. So that's all we know for sure. Where they're going to take us, we don't know, but you got to be riding it for now. And silver is now, looks like it has violated. So if you're using the 20 days, your stop, that's a violation. Your next stop now is a 50-day at 36.35, and my guess is it's going to get there, but we'll see. I may cover at that point, but I may cover at any point. We got a little bit of a profit.
Yeah, and expect this market to remain at this high level of volatility, meaning it's not going to go just straight down in a line. I mean, remember 2008, it went straight down, straight up, straight down. I mean, it was all over the map. So
yeah.
Based on, think about possible scenarios. If you're sitting on a nice profit, let's say you did buy the TNA when the model went to a sell signal a few days ago, and you're sitting on a 30% profit, you might ask yourself, well, what if we have a huge bounce and that half that profit vanishes? Are you okay with that? If you're okay, then sit with your position, because the market over the longer run, we might not have seen the bottom. We might not be close to the bottom. Who's to say?
LinkedIn, someone's asking us about that. If you had a stop on this thing, I would imagine that you should have hit your stop a while ago. So we got knocked out of it at like 99, I think it was 98. We were trying to hang on to it, but I think we got knocked out on this day. Actually,
it was right under. They actually had a low of 99 2 days in a row, July 28th and 29th. So we put a mental sell stop in at 98.9, a dime under 99. So
yeah, got close. And I think on this day we got stopped out right under there. So, and of course, it turned around and went higher that day. But that's okay. We did okay with that. And then we didn't really lose money. We wanted to be in position if the market did turn a rally. But, I think your stop should have been hit there. I wouldn't necessarily buy it. In fact, I wouldn't buy it at all unless I was on drugs. Anyways, Baidu could be a late-stage failed base. It's breaking the 50-day moving average. So generally what I look for is a break and then some kind of a rally. This could keep going. You could short it here using the 138.71 level at the 50-day moving average or the 141.11 level at the 65-day exponential as your stop. Whether that's going to work, I don't know. But I would actually like to see it maybe come down to 130, bounce, and then back up into these moving averages and then really hit it. But the market's not rallying, so this is looking pretty nasty. And let's just look at some of the garbage going on here. You got the Dow at 192, and that's just getting worse. S&P, I'm looking for 1140 on the S&P, and I think we're right about where we thought you could get to on the Nasdaq, but this is looking very weak. So you obviously don't want to be here on the long side, and we see silver's reverse, gold is barely holding up. So you had your shot to blow them out this morning, but if you're a tough guy or a tough gal, and you're trying to sit through, our view is buena suerte, good luck, or happy dreaming, as we literally would say.
Swiss currencies are going to new highs, FXF, and that has a somewhat of a correlation with gold, so that explains also why gold is holding its own in today's calamitous type of market action.
Mm-hmm. Do we expect QE3 soon? No. And you know what? QE3 might just be the big bid to hit. That's another question there. With all the whipsaw this year, is MDM up on the year, Dr. K? Yes.
Let me check. I'd have to check that because it's been quite profitable in the last few days, and before this profitable signal, the MDM was a little bit above water, then neutral, then a little bit underwater. On the 1 times Nasdaq composite. So if you took the Qs, for instance, the MDM relative to all the other models that I've seen this year was ahead, but it was basically the tallest standing midget. Is the best way to put it. In other words, all the models, as far as I can see, are down or they're having a lot of trouble. And I would say that let me just do a spot check here. I think the model is back. It should be back up for the year. It's just a question of how much it is up for the year. I mean, this last signal. Yeah, the quick answer to your question is yes, it is up for the year. It's just a question of how much. There's a lot of numbers here, so it looks like it's up at least a few percent this year, if not several percent, on a one-times basis.
Yeah.
Yeah, actually, I'm just running through the numbers real fast. I'm just doing a head calculation here. It looks to me like the model is up about 6 or 7%. I'd say 7% on a one-times basis, which means that theoretically the three times should be up 21% for the year. I would say that it's possible on something like TNA, which is pretty wild. TYH is also doing pretty well. That looks like, yeah, actually TYH. I'll do a quick. Go ahead and continue speaking. I'm just going to do a quick calculation here because I'm curious myself.
Well, some questions. The VIX is spiking here. That may be significant. That may not. I'm watching Priceline in here. I'm actually ready to come back into it and do a little bit right here. See if it breaks the 50-day. It should do it pretty quick here. And if it does, you're heading down probably for yesterday's low. So keep an eye on this one right now. Silver continues to break down. We're right down to the 50-day, just about. We hit 36.55. Probably heading for it. So we'll see where I end up covering this short on the short term. But I'm looking like 36. Well, 36.35 is what I'm looking for right off the bat. The 65-day, that was 36.78. So you're kind of in that zone. It could always cover half of it. And that would be my lunch money for today.
Yeah, it looks like the TYH, the three times Direction Tech Bull ETF, is up about 16 or 17% as we speak.
Yeah.
Given today's market condition. Being TYH looks like it's up just today about 9%. So, yeah.
Yeah, the confirming this, there's a question, will gold break on hedge fund managers? Well, we think you have forced selling, so that's what we're talking about. Is hedge fund managers, mutual funds, whoever having to raise cash or raise liquidity, even banks who have to shore up their balance sheets if they happen to be exposed to Europe and there's some issues in Europe raising their heads again, then that will happen. So we're going almost an hour. We're just kind of sitting here watching the market with you guys and checking out what's going on. So a little bounce on Priceline. You notice on the intraday it's back above the 20 period. If it breaks down below, possibly could come after it. Here we go. Yeah, so we'll do a little here and see if this starts to break down.
Well, also, if you look at the NASDAQ futures, and I've gotten over the years, there's volume, there's different types of volume, different qualities of volume, and from what I'm seeing is that we just had a very high volume sell-off, which does not bode well for say putting in a bottom here, and now the market is trying to rally on it's a pretty anemic rally, so I don't think we've seen the lows of the day yet. It's just my guess.
Doesn't look like it. So, but I'm looking at Priceline here. It's about to break the 50-day moving average. So that might be one to look at. So, but let's say if I was going to do this, I'd probably keep a pretty tight stop on an intraday basis, probably 520. That should be resistance on any rally from here, but it may not make it. It could be the 20 period here. Notice how it tends to follow the 20 period. It will blip above it for a little while and then roll back below it. So, there's some porosity here, but a lot of times this, for some reason, works. But my trader Bill told me that he saw a presentation once where a guy used this, so maybe there are a lot of people who use this, and that's why it may work intraday. But it is an interesting guide, and for some stocks and indexes in certain environments, it works better than others. So. Here's a lesson for you. Somebody says, funny, the only market direction model signal I didn't take as whipsaw was killing me, and this one is huge. So.
And that is, I'm not surprised. It's a natural tendency that if let's take an individual stock for example, or I'll actually use an example that Ed Seykota once told me. I love this story. He said what makes him different from most all traders is what he did with the Japanese yen. No, sorry, it was with coffee. It doesn't matter. It was with coffee, and this was, I think, in the early 90s. And he showed me this chart, and it looked like it kept trying to break out, then fail, break out, then fail, and it failed 4 times on him, and each time he lost money. And the 5th time, he went in, and he went in just as hard as the last 4 times, and the thing just skyrocketed, and it made his whole year. He was up something like 300% that year, and he said that's what makes him different. He just keeps at it. If he doesn't see anything broken, he didn't see anything broken with coffee, so he just kept going, and he kept plowing, and then he nailed it. I would say, because I know the way the market direction model works, how it functions, there's nothing wrong with, we have some members who just go in and, buy the signals, buy the inverse or buy the regular ETFs on the signals. And, in a year like this year, if you get burned 5 times and each time you're losing a little bit, on the 6th time, you might be gun shy. It's totally reasonable. But I would say that extends to, the stocks. If, how many people here would buy a stock a 5th or 6th time if they lost money on it the first 4 times? And mind you, that's to be said that the stocks still look fine, the charts still look fine. You just, been stopped out 4 or 5 times in a row. You'd probably be pretty gun shy about buying it a 6th time.
Yeah. That's normal, but that's usually the time that it works really well. Okay, any more questions? It seems like that's it. So you pretty much know where we stand on the market. Potentially rally, lose the precious metals, and we're looking at some short sale setups. But you may be long in the tooth in terms of trying to come in on the short side. But if you have a fresh setup, if this price line ends up working, I'm kind of watching the rallies up into 520. Resistance here. If it breaks down, we'll see. But if you do get this breakdown, that could be a very, very tenable short sale target. So we'll see. Last question. Somebody asked, will I run 2 or 3 stocks short 200% and only 2 or 3 stocks? If you actually go on the website, you can see where I show the results in one account that I was running on the short side in June of 2010, when I was up almost 100% in just 1 month. That was only really 3 stocks. I think it was X, U.S. Steel, FCX, Freeport-McMoRan, and RIM. And so, yeah, at some points during that breakdown, I was short 400% intraday. So, yeah, I'll go for it. But, I have deep pockets. As long as gold keeps going up, I'll always have a grub stick ready to go. Anyways, I think that's all we have for now. You can see the market's rallying, so you're in logical position here to get a bounce here. So just kind of watch for that, and that's where we are right now. We just kind of wanted to go over things intraday, so we're kind of seeing where the market's at. Volatile, but the sell signal remains. You want to stay on that. Okay. All right, that's it for now. Anything else, Dr. K?
I think that covers it.
Okay. And if you have any questions, feel free to email us, everybody. So that's it. We'll talk to you guys later. Good luck today.
Take care.